All right, so good morning, everyone, and thank you guys for joining me on this Sunday, June 29th, for this technical analysis class. Pretty much, we're just going to be going over gaps, pretty much how you can identify gaps on your charts, and some of the common rules that are used to kind of trade around gaps. Gaps, are kind of just a similar tool that you can use, like your support and resistance, just marking a key point of interest on the chart where you're expecting either volume to pick up or there's some sort of reaction to be from price, right? So how you can trade them, how to identify them, are the things that we're going to go over in this presentation. All right, so I'm just going to kick off things by saying that again, everything in this presentation is for educational purposes only. To use this information to then better your own trading. That none of this should be considered financial advice. We are not financial advisors, and legally, we can't provide you guys with that. So, anything you guys see, like in the group, anything you guys see in this presentation, again, take it for educational, informational purposes, and hopefully you can use it to better your own trading. All right, so we'll kick off the class here by saying what is a gap, right? So typically, if you take a look at the markets overall, right, the S&P, the SPX, the Nasdaq, and all the stocks that trade on the New York Stock Exchange, they only open up at that 9:30 a.m. Eastern time, as they close at 4 p.m. Eastern time, right? There is a pre-market and a post-market, where in the pre-market, the markets will open up at 4 a.m. Eastern time, and then they close at that 9:30, kicking off the regular trading session, and then there's a post-market that goes from the 4 p.m. ET all the way to 7 p.m. ET, right? So during times of this post-market, pre-market session, you could see times where you'll get a jump in the stock price, right? Where it closed the day previously, for example, say at $60, and then it opens the next day, say up around $70, right? And then when it does create that gap in that price, you'll see that fluctuation of that $10, and it'll be kind of an empty space on your chart, right? And gaps can be caused for numerous amounts of reasons, right? They can be caused if there is a huge economic shift, right? If, for example, tariffs and recent economic times, if there is a trade deal announced, you typically see a gap up in the price because there'll be overwhelming support for the markets to go higher. And if there's some negative news, then you'll see typically a gap down in the price. So typically, economic events, earnings, huge catalysts are things that can cause these huge gap ups and gap downs. Also, if you take a look again, futures markets, right? If you guys trade futures, I know a lot of you guys here on the member section do trade futures with us. Pretty much the futures market opens up at 6 p.m., right? And then it goes through the Asian market session, it goes through the London session, and then it opens up with the New York session. So sometimes you typically see on a day-to-day basis on the indices a lot of these gap ups and gap downs due to international circumstances as well. So pretty much again, a gap in the price is just that space on the chart, that blank space that's caused by a huge move up that happens during the overnight session or during the pre-market, the post-market session due to some catalyst, right? So pretty much once you identify these gaps, how can you trade them, right? And a lot of gaps do fall into certain different categories. There's called breakout gaps when you're seeing price consolidate in a tight range. Some economic catalyst comes in and then you see a huge jump up in price and it just goes. Or you can see what's called exhaustion gaps, right? When you see a gap up in the price, but the gap's up into a support or a resistance, and then it quickly reverses, ending up into a gap fill, right? So we'll go over some examples. We'll talk about the main situations as well regarding gaps and pretty much how you guys can trade them. So first, I just want to identify exactly what the gap is. So that jump in price. So if you take a look at the charts here, I can show you one example. This is on the S&P 500, the SPX, and you can see noticeably on your chart here that we're already seeing some pretty strong gaps up in price, right? And the two gaps that I want to bring attention to is the gap up that we had on April 22nd, as well as the gap up that we had on May 9th, right? And these two gaps were caused by economic news events, right? The first news event we had here on this gap up was when, Trump announced the tariff pause. He announced more leniency, right? And then that caused, economic tides to shift, right? Good news hitting the markets. So an overall shift up in trend sentiment, which was previously bearish due to the tariff related news, kind of just reversed it at 360 back, or oh, sorry, 180 back to the upside, right? So this is a strong example of a gap here where on the April 22nd, we had markets close at 52.87. And then on April 23rd, we have markets open at 53.95, resulting in a pretty strong gap up there, right? And since then, markets really haven't turned around. We're seeing constant push to the upside, right? The second gap we had was over the weekend on this May 9th to May 12th session, and that was due to the U.S.-China trade deal, right? U.S.-China started the negotiations in London. They came to terms regarding those rare earths as well as the restrictions on AI. And since then, markets kind of had a strong gap as well, right? Markets were primarily worried: is the U.S.-China trade deal going to happen, especially with the way Trump was posting on Truth Social that wire weekend, and then as soon as that surprise came in, markets gapped up and haven't looked back, right? So you can see strong gap ups like this on the price, but pretty much you're identifying any sort of space that takes place on the chart, right? And it's just a point of interest, right? If we're seeing kind of price below that gap, it could be used as an area of resistance. If price is above that gap, it could be used as an area of support, right? So just another point of interest that you can place onto your chart, pretty much. Okay. So pretty much in any gap situation, there's two situations that could play out. Either you can get a gap and go where you see that gap up or gap down in price, and then price continues to move in that direction, or you can get a gap fill where you see that gap up or that gap down, and then price reverts to kind of fill that gap. And then from there, do we see a fill that gap and then reverse with trend, or do we see a kind of a reversal in price back to the opposite direction, right? So those are typically the two situations that you can resolve around gaps, and pretty much how you can identify if it's going to be a gap and go situation or a gap fill situation is pretty much some common characteristics that are resulting in that price action, or even looking at the fundamental reason what caused that gap, right? If you're seeing a gap due to positive earnings, and that can sustain future growth. Like you had the CEO come out saying that, okay, the industry is doing very well. We had a beat on our revenues and our earnings, and we're projecting that future growth on our bottom line is going to be sustained or even might increase, right? If you see something like that, then that shows a very strong fundamental reason of why a stock price would gap up, right? You're seeing that kind of demand in the pre-market session carry forward into the regular session, and then you can get a kind of a gap and go situation, right? So if you have a strong fundamental reason and you're seeing accumulation and strength, once that gap out occurs, then you could see potentially a move up, right? And typically these situations fall out into a breakout gap, right? If you're seeing kind of price consolidate in a very tight range and then it kind of gaps above resistance, and we see that strength and accumulation, that could continue the price to the upside. Or if you see trend continuation, right? If you're seeing price kind of make those higher lows or those higher highs and it continue to the upside, and then you get kind of a gap at a higher low situation, that could also show strong continuation just with the overall trend, right? So those are two situations. Some good examples of a gap and go situation is from recent earnings. We had Microsoft and Meta, right? So if you take a look at the chart here, kind of putting on Microsoft, right? So both these companies had really strong earnings, right? If we just kind of remove the drawings here as well, you can clearly see that after Microsoft came out with their earnings, they had really good growth on their top and the bottom line, but they also announced a lot of future advancements, right? They announced an increase in CapEx spending in AI, and AI is kind of the hot topic right now, where companies that are announcing it, they're prospecting that future growth, the future impacts that it has on the bottom line. So you can see here on Microsoft that we had a gap up on a strong fundamental reason, and it was being backed up with continuation accumulation, right? So this was kind of a good gap and go situation, also where we were kind of seeing the consolidation in price, right? We got a double bottom here, and then we got a breakaway gap here, causing that continuation to the upside. Meta, also another good example of this, where we had, again, just for the similar reason, we had kind of a consolidation setup. We had kind of prior on this downtrend, and then we had a breakaway gap caused by good earnings, good report on their top and bottom line, and then also similar to Microsoft announcing that additional CapEx spending, right? CapEx spending in AI, creating that foster for future growth, leading to that gap out on that breakaway. This is also a good example of a trend continuation, as we had kind of subsequent gap ups, as Meta constantly making announcements, purchasing Scale AI, making acquiring new people on their employee base, taking employees away from OpenAI, causing all these subsequent gap ups in continuation with that trend. So these are some good examples of that gap and go, where you're seeing that gap up in price and then just accumulation and strength pushing it to the upside, right? The other situation here is if you get a gap fill, right? The gap, and typically when you see a gap fill, the gap up or the gap down is caused by an emotional response, right? If there's kind of a weak conviction or weak catalyst, maybe potentially fake news, that then causes the gap to reverse or even lead to a fill, maybe a longer term reversal here in price, right? So in a gap fill, you're typically looking at, if the gap pushes up into say a key resistance, right? Like if it's pushing up into a key level, either that could be resistance or it could gap down into support. And then you're seeing a reversal or kind of accumulation distribution happening in the opposite direction, right? Exhaustion gaps are a good example of this. We're seeing kind of price just maybe consolidate in a very tight range and then a gap up into that range resistance, leading to kind of prices push back, right? And a good example of this is pretty much on your indices. You'll see it a lot of times, gap ups, gap downs that tend to get filled on your major indexes like your NASDAQ, like your triple Qs. So one example of this is we can refer to the triple Q indicator, which happened on this April 29th, April 30th, right? So on this day, you had kind of a strong gap down in price, but it pushed down right into some key support, right? Gap down right into that 21-day and that 10-day moving average. So those are some key areas where buyers potentially could come in, and you can see on that session that actually did come in and pushing price back to the upside, right? It effectively filling that gap. So sometimes when you see like weak conviction or fake news, sometimes like on Friday this past week, right? We also had Treasury Secretary Bessent in the morning come out and say that they locked in trade deals with China, or they're establishing that framework. Markets gapped up on that and we're pushing to the upside. But then in the afternoon, we kind of saw trade deals take negative news when Trump announced that they're not undergoing they're stopping negotiations with Canada, right? And then we kind of saw a gap fill take place in Friday's afternoon session. So typically, when looking at the gaps, you want to see if there's conviction with that gap, pushing it in that direction, or if was that gap caused because of some weakness, was it rather an emotional response, and there isn't really that strong backing, then it could lead to that gap fill opportunity. Gaps could also be used as areas of where you want to target price, right? If you're seeing kind of historically on a chart, you're seeing a strong push up out of resistance, a breakaway, and you notice that there is a previous gap on the chart that is tend to be filled, you can potentially use that as a target area, right? And a good example of this is recent trades that we took in the group with AMD and Marvell Technologies. So if we took a look at AMD here, right? So this was kind of the basis for this trade on AMD, right? We had a strong inverse head and shoulders pattern. We got a breakout above that 200-day moving average. So this could have been our area to take long, right? And looking back at the chart, we've noticed that there was kind of a gap here on the upside as well, right? Between this 152, 159 level. So that could be a potential area that we're looking for price to target. Obviously, with trading, when you're in a trade, there's a lot more that goes into it. Like you got to make sure that there's momentum. You got to make sure that the setup is clean, right? But ultimately, when you have those gaps on your chart from looking back in previous price action, they could be used as potential target areas, right? Marvell is also a good example of this, Marvell Technologies, as we kind of had a strong reversal trade, and now we're looking for this potential gap fill up towards that 200-day moving average, right? So that's how you can pretty much use gaps on your charts, guys. Again, very simplistic terms, you can use it as an area of support and resistance. Look to see if price targets it, and then once you see that, once you see pricing pushing into that gap or caused by that gap, where's that conviction or that strength? Do we get that gap fill or do we see reversal, right? Typically, also in this gap area is an area of a lot of empty price action, right? You're not really seeing that strength or that resistance. Typically, again, if you look at the money profile here, right? Typically at each price level, you're going to have some sort of orders. You're going to have either limit orders, you're going to have market orders, you're going to have like market either, position themselves, at this key area looking at some previous either support or resistance. But in a gap, you don't really see that. It's a lot of empty space. So typically, because there's a lot of empty space, if there's that conviction, they do tend to get filled pretty quickly, right? The size of the gap also matters. If it's a wide gap, like how we're seeing here on MRVL, then it does take more work to fill that gap. So sometimes it does lead to, partial gap fills or not even like the full retracement, right? Narrow gaps do tend to get filled a lot more quicker. They also have a higher chance of getting filled. So the size of the gap also does matter. Wide gaps, again, partial fills, less likely to get complete fills on those. Narrow gaps have a higher chance of getting filled and do tend to kind of fill very quickly, right? Okay. So those are pretty much two situations. Like when you're looking for gaps, you're either looking for that gap and go, or you're looking for that gap fill, right? And gaps do tend to get filled. Mentioned earlier that also looking for narrow gaps or wide gaps can also lead to your decision making, right? And I also mentioned that they could be potential target areas. Now, for our trading, you'll see that typically, when in the morning when we talk about the market update, a lot of times you do see the market either gap up or gap down, right? The market does trade during the Asian market sessions as well as the London session, and now with kind of everything going on, the geopolitical tensions and in the world, you're kind of seeing that increase in volatility. So the market does tend to a lot of times open up either on that gap up or that gap down. And the major way that I trade it or how I see it is then I'll look at the market internals, right? I'll look at things like the tick indicator, the volume difference, the advanced decliners, because that tells me what's going on in the market, right? So this only works on the major indices, not really on your stock names, right? On your major indices, right? Because they include, all the stocks in the market, you want to see where that conviction or that strength lies. So a good example of this is if we go back to that triple Q example, right? If we go back to the triple Q example where we had on April 29th, we had this gap down in price and it pushed down right into support. So what was the internals doing at that time, right? If we take a look at the internals on the April 30th, they all open up negative, right? Because internals only open up from that 9:30 a.m. Eastern time to that 430. So on 930, they was telling us everything in the market was bearish. We had advanced decliners here open up in negative territory. We had the tick indicator open up negative, and volume difference was also negative, right? So this is telling us that a lot of things in the market are below the previous day's close, right? So typically when we want to see a gap fill, what happens is this kind of action where things start to revert, right? The advanced decliner shows that most things in the stock market started then moving above yesterday's close to the upside, and the tick indicator also started moving to the upside. So this indicating that, price might want to start moving up, and they're giving us that gap fill, right? If on the opposite end, we start to see, the advanced decliners holding negative, right? A lot of things in the stock market staying underneath yesterday's close and holding red, and we start to see ticks kind of holding in that bearish territory, meaning that more things are still moving in that downwards direction. Then we're going to get that gap and go, right? Then I'm expecting, triple Qs to either gap into this resistance. Maybe it was an extreme news event that took place, tariffs maybe back on the board. Like, I'm just giving you some examples. Maybe Iran shoots a missile towards Israel, some really negative impacting news event that then shows that, okay, trend is continuing to the downside. Then we're getting that gap and go situation, and maybe filling some of these other gaps here on the downside, right? So that's pretty much how I trade them. Again, pretty quick lesson here on gaps. There's not really too much to talk about, but just being another, again, point of interest here on the chart, right? So typically you want to look at it as either an area of resistance, either an area of support, and then see where that conviction lies. Is it telling you that, is it going to continue in that direction, or are we seeing that potential for a gap fill, all right? So again, a quick lesson there just on gaps. I know a couple people just wanted me to go over it. Again, there's a lot of different ways to trade around gaps. There's a lot of different strategies as well. If you do a quick YouTube search on like trading gaps, you'll see like a plethora of videos around them, right? So it is a very commonly used tool that is in the markets, and it also has that kind of self-sufficient prophecy, right? If everyone's looking for a gap, they're seeing the same things that we're seeing. Either is it going to be a gap and go, or is it going to be a gap fill? So whenever you see a gap, two things to consider. One is, what was the fundamental reason for that gap? Is it strong enough to indicate possible trend in that direction? Or was it a weak basis? Was it based off some sort of psychological reason? Was it based off emotions? Was it based off, fake or contradictory news that doesn't really support a move higher, right? So once you can figure that out, then you get a better indication of, okay, is it going to be a gap and go or a gap fill? And then keep an eye on things like the internal or the strengths or the reasoning behind of it to then see if, get that continued accumulation, or if it starts to fade. Okay, so that was pretty much just what I want to talk about gaps. Just a quick lesson there. If you guys have any questions about gaps, we could take it now. If not, I also want to talk a bit about trading psychology and risk management, and then we can do kind of an open period where you guys, if you have any questions, or if you guys want to talk about something else, we could talk about. So Grisserman asks, what is the psychology behind gap filling? Is it because there is low volume during the pre-market or after our session, and later the price can move quickly to fill the gap due to increased liquidity? Yes, exactly. That's it, right? So typically the gap happens during your overnight session or during your pre-market and your post-market, and there does tend to be less liquidity or less volume supporting it, right? You don't see much action happening during the pre or the post-market. It's very limited trading. So it does leave that empty space. And also I mentioned kind of if you look at the money profile, or if you look at any volume profile, during times of gap where you have that blank space, right? So there's no traction, there's no resistance, for price to move in that direction. So if you see strong liquidity in that direction, gaps for that reason do tend to get filled pretty quickly. But then once they're filled, sometimes you can see either, gaps get reversed, gap fill reversal, or you can get, a complete 360 move depending on the strength or the amount of liquidity that you're seeing, right? It's definitely case by case, scenario by scenario. That's why, we go through it in the live charts during the sessions from Monday to Friday, where we can, get better example of that. But yeah, exactly that. So the psychology behind gap filling is, does the gap happen due to a weak reason? Is there no strong fundamental reason why the market is gapping up or why that stock is gapping up? And then does that lead to, an opposite direction? And those gaps do tend to happen pretty quickly just due to, there not being much resistance or much traction at those levels. Okay. All right, so if there's no more questions about gaps, I'm just going to pause the recording there, and then again, this will be uploaded in the education